Chapter 1.2, Determining how transactions change in a counting equation. In this lesson we're going to talk a little bit about Calvin Paris. He's starting a repair shop. It's a small business service. Paris Repair Shop uses the account shown in the following equation. They are cash, supplies, prepaid insurance, accounts payable 4-Star Supply, accounts payable Riverbend Company, and capital. Let's take a look at the transactions. Well, the first transaction we have on here is we received cash from the owner, Calvin, as an investment of $3,000. So Calvin invested $3,000. Well, what's the first word we see there on there? We see the word received. Well, received means obviously that's an increase, and we received cash. So we take a look and we want to look at which account are we going to use. Well, received cash. Are we going to use the cash account? Correct. We are going to use the cash account, and it increased $3,000. Now, did we get supplies in this transaction? Nope. Did we get prepaid insurance? Nope. Do we owe 4-Star Supply any money? Nope. Do we owe Riverbend Company any money? No. So therefore, by process of elimination, we know that the other $3,000 is going to have to be an increase in capital, and the reason it's an increase in capital is because capital is the account used to summarize the owner's equity in a business. He invested $3,000, that's his capital in the business. Take a look at our balances. Everything was 0 before. Now our balance in cash is $3,000, and now my balance in capital is $3,000 as well. Next transaction, paid cash for insurance, $1,900. Well, first word is paid, second word is cash. That means we have less cash. We have cash going out of the business. So we're going to use our cash account again. However, it's going to be a subtraction. So we're going to minus $1,900 in cash. Now, did we buy supplies? Nope. Did we buy insurance? We did. And if you look at this transaction, we need to show that we now have more insurance for this transaction. So therefore, the increase in $1,900. We did not use the accounts payable, and we did not use the capital account. We now figure out our balance. If we had $3,000 cash and now we took out $1,900 to buy our prepaid insurance, we're going to have $1,100 in cash. Our prepaid insurance is now going to be $1,900, and our capital is going to be $3,000, staying the same. All other accounts will be 0. Let's take a look at our third transaction. Bought supplies on account from 4-Star Supply, $7,000. Well, first thing you want to see when you ever see the word on account, that's got to be a red flag to you to say, okay, this is either going to be accounts payable or accounts receivable. And you need to think about who you are in this transaction. Does Calvin owe people money after this transaction? And he does. Therefore, it's going to be an accounts payable. As we'll talk about later, if Calvin was to be receiving money in the future, that would be accounts receivable. But that's not the case for this one. Calvin owes money to 4-Star Company. That is going to be an accounts payable. But let's start off at the beginning again. Bought supplies. So did we buy cash here? Nope, we have no cash. What's our second word? Supplies. So therefore, we're going to use our supplies account. Do we have more or less supplies after this transaction? We have more supplies, $7,000 more. Do we have any prepaid insurance? Nope. Now, I told you on account means when you are, it's going to be accounts payable because Calvin owes 4-Star Supply $7,000 that he bought. Basically, Calvin called up 4-Star Supply, said, yeah, I need $7,000 worth of red staplers. 4-Star Supply says, we'll ship them right over and we'll put the invoice in there and you pay it within 30 days. That's what an accounts payable transaction is. Don't owe Riverbend any money yet, and our capital stayed the same. Let's figure out our balances. Cash is $1,100. Supplies is now $7,000. Prepaid is $1,900. Accounts payable 4-Star Supply is $7,000. And our accounts payable Riverbend is 0, and our capital is still $3,000. Final transaction is we bought supplies on account. There's our red flag again, on account, from Riverbend Company for $30. Well, let's take a look here. Bought supplies. Did we use cash at all? Nope, not in this transaction we didn't use cash. We will use it in the future to pay Riverbend, but right now we're not using cash at all. But do we supplies? Yes, we did. Do we have more or less supplies? Well, we're going to have more supplies. $30 more supplies. Maybe he needed some staples to go with those $7,000 worth of staplers that he bought from 4-Star earlier. Did we buy any prepaid insurance? Did not. Do we owe 4-Star Supply any more money? Nope. But do we owe Riverbend Company more money? The answer is yes. We owe them $30. And did our capital impact at all? No, not at all. So in this transaction, basically what happened is Calvin called up Riverbend, said, "Hey, Riverbend, I need some staplers. I need some staples for my staplers that I just bought. Can I buy 30 of them?" Sure. We'll put them in a box, we'll ship them over, and we'll put an invoice. You pay us within 30 days or whatever the terms are. So he owes them money. Okay? And if we do our new balance, our cash balance is $1,100. Our supplies is $7,030. Our prepaid insurance is $1,900. Our accounts payable 4-Star Supply is $7,000. Accounts payable Riverbend is $30, and our capital is $3,000. As you can see here, it's pretty simple, straightforward. Our assets equal our liabilities plus owner's equity and our accounting equation balances.